Cool. Kia ora, everyone. My name is Casey, and I'm with Territory 3 Kiwi Landing Pad Reimagined. Welcome, and thank you for coming tonight. Just a quick check, making sure on Zoom we're doing a webinar, recording this live and streaming. So if folks tuning in, if you could just let us know that you can hear us okay. Few things to kick off with a bit of housekeeping side of things. For the toilets, we've got some immediately through these doors to the left, as well as downstairs, gents on the right, ladies to the left. In the case of an emergency, if there's a fire, stairwells, not lift, and the assembly point is when you exit the doors at the front of the building, hang a left, and then a second left at Tony's Tyres. Just kicking off real quickly, I want to do a shout out to BNZ. We've got Alex here tonight. Where are you, Alex? Over there. Thank you so much for hosting us in this amazing venue. Can we have a round of applause for just keeping this place open for tonight? Stunning place, stunning views, and great people. I also want to give a shout out to Startmate and the Blackbird team, Sam, Tip, Phoebe, and Ryan. They've been doing a lot of mahi this week, doing a roadshow throughout New Zealand, helping upskill and work with founders across the country, and helping them bring their kind of dreams to reality. So you were doing a session earlier today at CapacityHQ, which I was part of, which was fantastic. Grateful for you to continue that through to tonight. Just for some structure on the way we're going to do tonight, we're going to whip through, or Phoebe's going to whip through a presentation, just to kind of outline some of the awesomeness of Blackbird. From there, we'll jump to a panel discussion where Sam's going to not lead it because her voice is, after obviously the roadshow side of things, is not quite there. So thank you for your mahi of pushing through and still making it for tonight too. But we'll do a panel discussion, so I'll invite Ryan, Phoebe, Tip up. I've got some questions prepared. If you guys have questions, very much keen to just make this as engaging as possible. So on that note, I'll shut up and we'll jump into the presentation side of things. Oh, actually, no. One other thing. New t-shirts, new brand, Territory 3. Just want to do a massive shout out to Five and Dime team for their hard work on helping us with Territory 3 Kiwi Landing Pad Reimagined. We are over 10 years into the journey of helping founders, of course, founded by John Holt over there, who's done a lot of hard work in the space, working with founders over the last decade and having successful exits himself. With Territory 3 comes a new way of how we're doing things. It's still very founder-centric and community-driven, but it really moves in towards helping startups go global from New Zealand into all sorts of different markets, not necessarily just the States, although that is still the heart and the spirit of where Kiwi Landing Pad came from. With that, Phoebe.
You're a big audience, so I'm going to be doing this. I'm going to try and not use the mic mostly because I won't have these hands doing these things, but let me know if you can't hear me. Hopefully all good. Well, got a yes. My name is Phoebe. I'm part of the Blackbird team. Joined 4 weeks ago, so let's see how I can do my first test here. Who knows Blackbird already? Okay, so you'll already know that we're a technology venture capital fund that exists to supercharge Australia and Aotearoa's founders. We invest in the wildest of hearts with the wildest of ideas right from the beginning. So we love to invest super early in your business and be with you throughout the journey. And we've got really cool animation. So we have been here in New Zealand investing since 2017, and we've now made 9 investments, with 1 also yet to be announced, in companies from hardware, deep tech focused companies the likes of Freightfish, AOM, and Innovation, through to software companies like Ask Nicely, Multitudes, and a few that don't quite fit either of those buckets, team down in Christchurch, partly up in Auckland, Sunset Meets as well. We have a dedicated $60 million fund for Kiwi founders that we raised last year, and that's supported by a more than $450 million follow-on fund. So that's what we mean when we say we want to invest early and then meaningfully follow on as we scale. So we're 4 people and you've got everyone here tonight. So please hit us up and come have a chat afterwards. We also have 40 colleagues now and growing in Australia. So Blackbird has more than tripled in size in a year, and that's really kind of demonstrating that we are as committed to being ambitious about venture capital and the community that we're building in Australia and New Zealand as ambitious as we expect our founders to be about the impact that they're having. Okay, so today our topic is from coffee meeting to term sheet. And we're going to talk about what happens mostly after you've started having coffees with investors, hoping to get towards a fundraising event. Before we get too far, the one thing I want you to remember is parallelize your process. What does this mean? It means try and group these activities in order. Sounds simple, but it will save you a lot of time and headaches if you can think about it this way. All right, so you start with a bunch of outreach. You have initial conversations with investors. You want to tell them what you're up to, what problem you're solving, why you're solving it in a compelling way. All of the pitch that you've been practicing in front of the mirror. Then you want to move into a due diligence phase. Then you want to move into a term sheet phase. The issue with not grouping these activities is you start to prolong the pain. So the risk is you start with coffee, you think it's going well, you think they like you. They say, let's get in deeper. You go into due diligence phase, doesn't kind of work out. Then you start again. Doesn't kind of work out. Then you start again. And pretty soon you spend a whole year being frustrated and spending heaps of time. So parallelize that stuff. 50 coffees in a row. 100 coffees in a row. Your coffee chat is going to be so good by number 9900. You are going to be so primed. And likewise, due diligence conversations, getting into the nitty gritty, group that stuff. So, minimum 50 copies. You think I'm joking. If you are a CEO, and it's probably the CEO who's going to be doing most of this, and you're committed to the venture path, you are going to be fundraising for a long time. It's going to become a material part of your business and what you do day to day. You probably should expect to spend roughly 6 months of every 18 months thinking about fundraising. And so the minimum 50 copies is truly a minimum. If you don't like coffee, figure out what you do like. So with the coffee meeting, if you're doing 50, then probably not everyone is leading directly to a term sheet. So how do you make the most of those meetings without getting discouraged? Our advice would be make your coffee buddy work for you, make your investors or your prospective investors work for you. So if they say, thanks, it's been awesome to learn about your business, it's not quite a right fit for our fund, or just not right now, or come back in a year, don't take no for an answer. Ask, wow, thank you. What else can I have? Who could you introduce me to for whom it would be a good fit? Who could you introduce me to who does this kind of investing or is kind of willing to do these earlier stage deals, whatever it is. If not an introduction to an investor, can they introduce you to a customer that you've been really trying to unlock? Or even talent, can they help you spread the word about jobs? There are always things that people can give you. And if you're at the point where they've just said no, they're probably feeling a little bit guilty and they're going to be willing to help you out. So make the most of that. The other advice is manage this process closely. So coffee, if you didn't get a yes, no, if you didn't get a yes, it's probably a no. And if you definitely didn't get a no, follow up, check quickly, move on. Can hurt, but if you're going to do 50 of them, you've got to be efficient. Okay, so you've grouped all your copies. You've done a month of coffee meetings. Your pitch is really great. You're really caffeinated, and you're ready to move people through to the next stage. There are a few where coffee meetings have gone well. Maybe you've had some other chats to investors at the fund, and you're getting to the point of due diligence. What do we mean by due diligence? Basically, there are 3 kinds, and most, at least 1 and 2, will be relevant to every business at every stage. So commercial due diligence involves a few things, and it is going to depend on the nature of your business, how developed it is, whether you have any revenue, for example. But it can include things like a financial model. If you're raising a certain amount of money, investors want to know what you're going to spend that money on and hopefully what your business is going to look like over the next couple of years. It's a heuristic no one knows exactly what's going to happen. You might be surprised to learn that the way that people project their business often doesn't turn out to be true. But what it does allow you and your prospective investors to talk about is how the business model works, what this money will allow you to do, and test that and start to talk about it. So this is really things like a hiring plan. Who are you going to go and hire with this money that you're raising? How much are you going to be spending on AdWords, on different marketing channels, just to show that you've really thought about what this money is going to do and where it's going to get you. Hopefully you have thought about that before you've gone out to market.
Sorry, wrong.
This is
I wasn't laughing at
so think about like really starting from like bottom up. So when people are like, if people come and they're like, I really need $1.5 million. You're like, awesome. What is that going to get you? How many people? Of what sort? Like what salaries do you have to pay these people? Etc. So yeah, think about it. Commercial diligence can also include more details depending on your business model. Could be the sales pipeline. So it could be like, well, we're in 15 active conversations with these major enterprise customers. You can see right here how many of them so far progressed on the sales funnel. They are surely going to deliver revenue for my business. This due diligence phase is still sell mode, right? Like you don't have a term sheet yet. You really are talking about what your business looks like, trying to really get a sense of where you expect it to go, and continue to sell the investor on why they should back you. So you may want to also talk about your product roadmap, make that available to them, get them excited about the long-term trajectory of the company and why it makes sense to raise venture capital to begin with, and particularly what's going to happen between this fundraise and the next one. Could include things like product analytics. So if you are running a software service and you can start to share some of the dashboards that you use to understand what's going on with the product and the customer base, then that can be very compelling for the investor to understand how you think about customer love, what kind of metrics you're seeing, and how those are tracking. Even, like, I guess what can be really exciting is week one of the diligence, you see the metrics, and then by week 3, they've already done even more things. And so making that part of the conversation, updating what's going on can be really compelling as well. All the stuff are things that you would, even if this is your first round of financing, are probably things you're going to start to share with your board and start to share with your investors and advisors and fellow travelers anyway. And so getting into the habit of how do we look at our business? How do we talk about it? And how do we update our various stakeholders? It's really good practice. You might be in a situation where you don't have a product yet, but you've gone out to market and tested with prospective customers the thing that you are building. And so even giving references or quotes from people who fit your customer target profile, they give a sense of yes, this is a good idea. Yes, people are going to buy it. Yes, they're willing to pay this much. Those sort of things are additional kind of fuel to the fire. Investors are going to want to see your cap table to get a sense of who owns the business today. Is there any debt on your balance sheet? For us, and maybe this is counterintuitive, but we are really looking for you as founders to have enough equity to take this business a long way. And so for us, it's problematic, really, if you don't own enough of your company, and it's a conversation we would absolutely want to have with you up front. So don't always think that because you own, just don't be surprised by that question up front. It can be a bit confusing as to why someone would want to know that in the first meeting or even the first couple of meetings, but it's really, at least from our perspective, to make sure that you are going to be aligned and in a great position to take the business far. We really think about investing in people, not companies, and so it truly is about getting the right starting point from which you can grow your business. And you can share other stuff if you think it's compelling. If you really care about your team culture, you measure weekly how people are doing with a tool like Culture Amp or something like that, share that. Show how much you care about it and how you think about hiring. Because again, to go back to financial model, probably what you're going to do a lot of with your dollars is hire people. And we love to understand how you think about that, how you're going to be a great manager, and how you're going to be a honeypot for the best talent. probably got too commercial. Legal diligence, also very important. So this is, at a minimum, this is checking that the company exists, that if you have any sort of intellectual property, that it is in the ownership of the company or people within the company, and that any IP that's created in the life of the company gets assigned to the company itself rather than to employees. So checking out your employment contracts, what's the wording in there? Are there any funky legal structures involved? And you may be in a situation where if you haven't raised money in the past, you may not really have a constitution, or it may be a really kind of like the constitution off the Law Society website or something. So producing these documents and then actually getting your investors potentially to give you input on them is one path you can take. I guess our advice would be think about stuff before you need to fundraise, to get a little bit of advice from a tech-focused law firm. We like Kindred, Avid, Legal Vision, Del Valley. Those are all ones we've had experience with. There may be others, and do share if you know. But the key thing is get ahead of that before the final process. Technical diligence. This is what we mean by this is if you have again like an IP heavy product, even a software product, depending on the company and the investor, they may want to send in an expert who like really understands what they're talking about to check that the product does what it says it does, that it's robustly built and that it's scalable, these sort of things. So I guess I'd encourage you to think about that as an awesome opportunity to pick some expert's brain when they're kind of like sitting and spending time with you. So try and treat that as like a two-way exchange as well, rather than kind of being freaked out, unless you've got something to worry about. But try and kind of use that as like an opportunity to invite feedback potentially on your product, or at least have this kind of validation stage too. So NNA, no NDA, I think it seems to be. Yeah. So generally, like, especially in the early days, getting too caught up in making people sign NDAs is often just a bit overkill, unless there is a really good reason for it, like you'll waive ownership of your patents by giving free access to proprietary information. So veer away from that if possible. I think if you're like a Series C or D company and you're talking to investors who are looking to a lot of similar businesses, competitive businesses, and they might share your customer unit economics file with someone by accident, it's a bit different. But for the most part, especially if you've only just put your constitution together, don't get too caught up in the NDA thing. Okay, so the way the process usually runs, you've had your coffee chats. Some people have gone to due diligence. Some people, having reviewed these documents, your financial model, etc., will say no. In many cases, you will then go to partner pitch. Now, if you were coming to Blackbird, we would actually do partner pitch ahead of due diligence. We like to give a kind of quick answer, a kind of go, no go, so as not to waste your time, but it does depend on the firm. So in any case, at some point, you will pitch the partnership, usually, of the fund, maybe partnership plus. In our case, you can have like 16 people on the screen. I'm just curious. So there was a partner pitch, or at least a pitch coaching workshop earlier today, but I'm not going to repeat. There's quite a few cool recorded versions of that sort of coaching available online via the Blackbird Giants YouTube channel. So if you do want to watch a video about that, definitely check that out. Okay, final stage, success, Timesheet. Again, ahead of this like whole fundraising process, understanding what key terms of in a term sheet are is a really good idea. So as you sort of start to warm up in terms of fundraising, picking your lawyer's brains in a quick and cheap way around, and they can probably share some resources with you, just to get a handle on like what are the things that you might be negotiating, what sort of pushback could you get from investors, what should you be prepared to talk about. At this point where you have people, making offers to invest in your business, it can be pretty overwhelming, especially when you get one and you don't know whether to accept it, and you might have someone saying, it's a bit of an exploding offer, like you've got to sign by Monday, otherwise it goes. With that sort of thing, and it can come like culturally, maybe US investors are sometimes inclined to make those sort of offers. Don't get too caught up in that, because if someone's giving you that offer, there's probably a pretty good chance someone else will give you that offer, and being too pressured into accepting the first thing that comes your way is not the best position to be in. I guess back to our kind of like parallelizing advice, trying to create some competitive tension. That's almost the whole point of lumping these stages together. And so if it comes to it, saying no in a situation where you feel under pressure is better than kind of ceding to the first thing you get in many cases. Easy to say in the abstract, of course, it's much harder if you're running out of cash, or you're kind of in a situation of having one term sheet and nothing else. But there are a lot of people probably in this room, in the communities that you're operating in the tech community, who can talk you through that stuff. So a lot of people would have been in that position. Always worth asking for confidential advice. In terms of terms themselves, one question we get a lot is kind of, what is the right level of dilution for me as a founder to take, particularly kind of in the first couple of rounds? How much ownership of my company should I give up? And the way we think about it certainly is to ensure that you as a founder or founding team have enough ownership for you to be incentivized for the long term, and there'll be a plan in place for that to continue, even if you go through successive rounds. If you're on a venture path, you are kind of committing to giving up ownership of your company in order to grow much, much faster than you would if you were funding yourself. And so obviously you have to be prepared for that. There's a bit of an average or consensus around venture rounds settling on a kind of a 20 to 25% dilution per round. But the main thing to think about is what amount of money you need to reach the material milestones that are going to set you up for the next fundraise. So that's back to financial model, a realistic one about who do you actually need to hire, how long do you think it's going to take, how many marketing dollars do you need to spend, and will that get you with a bit of wiggle room to the milestones that will look attractive to a kind of Series A or whatever it is investor. And if that kind of like money milestones equation makes you nervous, that's maybe the venture path is not the right one for you. But there are alternative options, but this is kind of like standard venture funding. For really first rounds, like more like friends and family rounds or angel rounds, pre-seed rounds, the dilution might be less, like 10 to 15%. It's kind of what we're seeing. But I guess our main advice is it can be detrimental to raise too little too often. For a start, because you're constantly having coffees, but secondly, because you haven't been able to convert that not quite enough amount of money into the milestones that really allow you to, I guess, raise compelling, convincing rounds. So, which is one way of saying, I guess, tend towards having a bit more runway than a bit less. We also don't know what's going to happen with the macro environment, and I think you do talk to a lot of people who were fundraising in March last year and did have trouble closing rounds because of COVID scare. Actually, that corrected pretty quickly, and in most cases was fine. But who knows, I guess, what's going to happen next time. So better to have a little more buffer. Another thing we haven't talked about is like, who should you choose? So this is kind of like a marriage that you're signing up to with your investors. Hopefully, if all things go well, you're going to be working with them for 8, 9, 10 years. And so working with someone you think you can trust, who gets your business, who's aligned with you on your mission, which could mean, you know, understands your that over time you want to, I don't know, like, do you want to list publicly? Do you want to return ownership of your whole business to your employees? These kind of things. If that's something you really care about, being kind of upfront about that is definitely worthwhile. And through this process, again, like, ask your potential investors to start showing you the things that they can do for you. So a lot of people in the coffee meeting stage will say like, oh, you know, so connected in XYZ, or like, oh, I know Elon, like, let me just give them a call. Like, get them to start putting their money where their mouth is effectively, start walking the talk through this phase. I guess it can be easy to focus on the fact that you're trying to sell the opportunity to them, and remember that they're also selling you. So that balance is hard, like dating. The other thing to think about when you bring investors on board, you can be in a situation where you're kind of like putting together a group of investors that's complementary. Having some like brand recognition value can be a great signal for the next round. So maybe you have a lead, but you can also entice some big brand USVC to do a little bit of your round. For the next time it's impressive. Someone else like, oh, I see XYZs in that company, I'll take a look. Another thing to think about if you have a very capital intensive business model is picking investors that have deep pockets and are going to be able to follow on in multiple rounds beyond this one. The final thing to think about is who from the investor or the investment fund might be sitting on the board. What are they good at? How many other boards are they sitting on? Are they going to have enough time to spend with you? What is their personality like? Are they getting along with you, with your other board members? I think this is meant to say sign and wire. Canva fail.
Oh no. Yeah, like a
yeah.
Microsoft computer.
We will need to do that because the Surface saved us today. I guess that's it. Yeah, you've got your term sheets, picture investor, you sign, they send you money. It's amazing. You get to have a little rest, and that's enough talking from me. Yeah, we'll have a panel.
Oh, Phoebe. So if we have Tip, Phoebe, and Ryan, and let's do a bit of a fireside chat. I've got a bunch of questions that I've crowdsourced from a number of founders in this room. I'm very keen for it to be an engaged conversation. So some of the things I'd like to touch on would be product market fit side of things, great founder versus great opportunity and how they weigh up against each other. I've got some questions for all of these. Metrics that matter. What's the non-bullshit metrics that actually move the needle in the conversation? I know there's a lot of vanity metrics, that sort of thing. Dilution we've already covered on, but if we touch on that as well. Time frames and a bit of execution strategy. So a few things to cut through. I might just grab a stool as well. Can I have a hands up for founders that are looking at raising a round right now? What about in the near future? Potentially might do some fundraising. Cool. Hands up for any that have raised money and are looking at follow-on round. Cool. Okay, so maybe if we focus kind of like 60-70% towards first time raising, and then also kind of put some towards follow-on rounds as well. All right, so maybe if we start with product market fit. If a startup approaches you, what are the signs straight away that get you excited about the opportunity versus what are some of the signs you pick up that you're like, this isn't going to work?
The main one for me is we see first-time founders or very early-stage founders, very obvious where they're coming to you to kind of look for validation. Like, is this something that you would invest in, and am I on the right path? And it's kind of like, whoa, you tell me if that's something that you're supposed to be the expert in that field, and I'm here to learn from you and see if this is something that you have some unique insight that you're trying to teach me. So it's very much a different kind of approach when you see a founder with high conviction. They're there with a bunch of learnings, they've already done a lot of things and proven some sort of validation, some sort of traction by bootstrapping, versus a founder who has a what I call a promise deck, but they're like, this is the stuff that I want to do if I raise a fund, if I raise some funding. Do you think this is a good idea? So it's kind of very different conversation.
Okay, so conviction.
fiction and learning.
I think the other thing is a lot of people spend a lot of time on the problem and the solution, but haven't necessarily gone out to customers to get feedback. And that is really kind of what product market fit is. It's like, well, you have the thing and people want it. And so even if it's pre-product, getting a sense that they know who the customer is, they know what a good customer, a bad customer is, where they live, what they like, what they do, in the company sense as well. And hearing them talk compellingly about that and how they're going to measure the impact of their product on their customer, even if they can't do that already. So I think that's a little bit like, have you actually thought about who's going to buy it?
Yeah.
You're surprised how many people.
And it ties into like the learnings and the conviction that they build from those conversations. Is there kind of like an expectation on how many customers they should have probably talked to? I know this depends on the model that they're working on as well, but would you have any kind of points to that?
I think I kind of like hearing when they talk to customers and they've unlocked this insight that they've really have only got because of that conversation or those conversations they've had. And then it's like, this is leverage they have that they went out there and got it, and then they've used it to really charge forward and drive like growth or whatever that step is that they're right at that point. And you can really tell they've actually talked and gained that rather than read something online.
You have different ways that you can validate as well. And a sort of an example where Michael Fox, who founded Shoes of Prey and then later went on to found Fable, when he was validating Shoes of Prey, he went and kind of did surveys with women who wanted to have customized shoes and said, hey, do you think this is a good idea? And the survey came back with, yeah, I'll buy this if you build it. And you think that's a good enough validation, right? Like you got people to say yes. But when they actually built it, they found that most people actually women like to look at shoes on celebrity and Instagram. They want those pairs of shoes rather than going and designing it themselves. And so even that level of validation didn't ultimately lead to people buying the product at the end of the day. And so he learned from that. And when he built Fable, which is a mushroom meat company, totally different field, he actually went to the supermarket and just stood there watching people buying plant-based meats, like watching where they go, what are they looking at, what are they picking up, what are they putting down? And like observation is so powerful because that's actually, you're taking learnings from people's actions rather than just their words.
I suppose it's also a case, like especially like in New Zealand culture, where sometimes people say what they think you want to hear, opposed to actually just pulling it straight. And then to that point, right, they can go and build it, and then you're like, yeah, actually, nah, I was just moral support.
Yeah. The book, the mom test is really good because it's kind of like you ask your mom, like, is this a good idea? And like, yeah, honey, of course, whatever you want to do, kind of thing. But it's like you have to kind of tease the customers out in a way where you're not selling to them straight away, but really try to identify that pain point and don't talk to your mom.
Got it. Cool. Metrics that matter. What are metrics that really move the needle for you? Again, I know this is like very generalized and there's lots of different models, but what are some common ones that founders should be thinking about?
I would say the metrics that don't matter are the very high level stuff that doesn't really show engagement. So you can game the system and have thousands of downloads, but if the customers don't use the product in a way that you want them to use the product at the end of the day, it doesn't matter. You give this example so many times. It's such a great example. Is every metric that matter differs for every company, and you should know what metric matters to you. So the Canva example is looking at the entire user journey. So for them, the metric that they measure is the numbers of designs published, and you wouldn't use that metric for your company, but it works for them because it shows the entire successful user journey. User signs up, users create this design, they save it, they come back, and then they publish it to the wider community, and then sharing that creates inherent virality inside the product. So that metric for them shows the correlation between, engagement, and also if you map that against the revenue, it goes up hand in hand. It's like the precursor, like the signal to an increase in revenue over time. So it's company specific.
Yeah, the connection between like the metric and the business model is really key. So, for example, there's a company called Remitly. It does like digital remittances, and they would see that people would try it, get a free trial, classic customer acquisition strategy. But the customers that would come back and transact again in the next month, all of them would go on to have this crazy repetitive customer journey. 40% of them would come back month on month on month over years because they got into a habit. And so you might see that slide as an investor, I guess, and be like, oh, there's this huge drop off. It's like 100 to 40%. But they could say, don't worry about the 100, focus on that 40. That's like we re-baseline there, and then we just get like this mad customer behavior because they love us, they form a habit. And so it's kind of being able to say like, not only what's your repeat rate, but like where should you start measuring that from, and why does that matter, and then how does that flow to like unit economics? It's more understanding how your business makes money and like what metrics show you that it's working.
Oh, okay. So if I play that back, in the beginning, it can be very much talking to lots of different customers, make sure you've got that closed feedback loop. But then it goes in the direction of almost like that 1,000 true fans, making sure they're actually like genuinely getting value from the product and sticking with it and engaging with it, not like the vanity metric of just downloading. But then you need to tie it towards how you're going to scale that to your business model. Side of things.
I think I would probably just add to that. Another good example is Superhuman, the email client.
Yeah.
Like moving email providers is already a big deal. And the way they look at it is they ask their most evangelizing customers, what would the feeling be if this didn't exist anymore? And imagine like Gmail disappeared, right? It's like, oh, okay, what would I do all of a sudden? It's a huge piece to understand customer love. And it's a really good way along with the month on month, you can really understand what's the satisfaction, how valuable are the customers in that group.
So things like NPS score.
Yeah, and that can be easily gamified. So the main thing you want to focus on is, well, first of all, you're calculating it correctly, because this, yeah.
Common problem.
Yeah. When did you measure it? So that can completely change. Like, did you measure it immediately at purchase? Did you measure it after they were billed their subscription again, or after they tried to cancel or whatever? Like, and you can have many different types of NPS that you measure for different reasons. What the distribution between like how many detractors and promoters and neutrals you get is also relevant, because you can get the same score from quite a different mix of those. I guess I'm always keen to know what you do with the information, what you hear from, like what comments you get from promoters and detractors, and kind of what you know, and then what you did about it. So yeah, think about like how you're measuring it, when you're measuring it, and then what you do with the feedback. And you kind of ask it in the right way and that stuff. But it can be really powerful. Another thing is we have, someone might say like, oh, we've got an NPS of 45. And I think what I always like is like, well, who are your promoters? Is it like, who is your best customer? Is it like the 1,000 biggest fans? Is it the people sort of like what you know about your customers beneath the top level metric, rather than just saying like it's 40. Or in benchmarking. So if you're an insurer and you've got an NPS of 0, you are doing super well. And so it's relevant to say like, this is what our peers get, to the extent you can find it out. And then culturally, if you're in the US, NPS trends higher. If you're in France, it trends way lower. And so all this context really, really matters. So
Cool. Okay. Keen to move towards valuations side of things. We were talking before about, in the presentation, mentioning kind of stock standards around probably 20 to 25%. What sort of valuation do you commonly see for first time or for a seed round? Again, I know generalization, but the best you can.
I think when you look at valuation, it really kind of just boils down to two things, which Phoebe mentioned in her presentation, which is what are you raising for and how much you're willing to be diluted. And what you raise really depends on what stage you're at and what milestones you want to get to. And that really determines the valuation. So there's no kind of like 3 million is the answer kind of thing. It's if you're raising $1 million and you are hiring XYZ to get to a certain milestone and you're willing to be diluted by 25%, rule of thumb, roughly valuation like 4 mil-ish up. So it's kind of, I think that's a more useful answer to think about what you're raising dilution versus, okay, do I fit into this bucket of first time founder? This is the valuation I should be aiming for.
Cool. And holding that in mind, one of the things that I hear quite a bit in the ecosystem is that founders feel that they get over diluted. Do do you guys see that within startups and founders that you're investing in?
Yeah, I mean, there's like, like when I was back in Sydney, sometimes you see founders like, hey, raising around, founder like raised once before and they sold their company, like 25% of the company for a couple of grand kind of thing. So it's kind of like, you do see that and that's horrible and recapping is really hard. So like as a cautionary tale for the new founders in the room, like really think about who you want on your cap table. It's really hard to remove founders from cap table and really, just think about how much you need to raise, how much you're willing to dilute for by. If you're pre-series A, we expect you to have the majority of the shareholding, like 80% up, so that when you raise future rounds, you have enough for your ESOP, you have enough for large cornerstone shareholders to come in and they can build a meaningful position in the company as well.
Sorry, for Series A, you're expecting to still hold 80%.
Pre-series A.
For pre-series A, yeah.
Gotcha. And if we were to unpack like the reasons that the wheels can fall off if dilution happens, is it because then when future investors are wanting to come on, they feel that the risk is leveraged up because the founders have less, so there's got to be more heart to what we're doing to push through the challenges? Or what's the thinking on why the over dilution makes investors less likely to want to jump on from this perspective?
I guess it's partly like, some investors might approach it in focusing on the idea and the company itself, and maybe less concerned about the individuals, founders behind the company, and kind of investing more in the idea and like, oh yeah, what could this be worth and how much money is it going to take to get there? We definitely take a founder-centric view and are like, what's going to set you up for 10 years of raising every 18 or 24 months? And if you start with too little right now, it's really hard to create enough kind of space in the equity stack as you go and raise those much bigger rounds from institutional investors. You, as a founder, you will get a portion of the ESOP through, and you will be incentivized along the way, but you can't really undo the starting point. And so that's there's insufficient incentive for that founder to do their life's work and build this company, which is kind of at least our thesis in the way that we'd like to invest. But that's one group of, there's one approach.
I'm sorry, I lost my voice. I just have to say, like, part of it as well is that when you go on a cap table, you put your brand behind what is on that cap table. But we will not put our brand behind over dilution of founders. That a lot of top tier firms, particularly USPCs, feel the same way. And fixing that means recapping, and what that really means is going to have to fight with early stage investors. Early stage investors who sometimes refer you deal flow, who you would like to maintain good relationships with. It's a really hard thing to do. You don't want to be doing it more than once a year because it's really hard and it hurts relationships. But I would say the most important thing is to really raise enough to last you 2 years. Because if you're like, that's what creates the over dilution. It's not that the valuation is too low. I mean, that's part of it. But if you're raising every 6 months and someone's going to take 10 to 20% each time, you're wiped out within 2 years. And it's really hard to undo that situation. And it's quite unfair too, because the early stage people have taken a lot of risk. The second thing is parallelizing is the best way to get the most term sheets. Competitive tension is the only way you optimize price. You wouldn't sell your house going one by one down the street. You get everyone in a room bidding at the same time, and your company is much more valuable than your house. So think about it that way.
Awesome. Do you guys have an opinion on preferred stock versus common stock?
You probably won't get a choice.
Yeah.
Could you unpack that a little bit? Is it maybe a new to preferred stock versus common stock? Why that's the way to go?
I think for us, we have certain terms that we have to have. So for example, kind of making since we follow on, we want to be able to maintain a certain percentage ownership or have the rights to investing, when you come in to raise, especially for investors that are lead investors or cornerstone investors, especially, we have a certain way of investing, like startups raise every 12 to 18 months. If we love the company, we want to build ownership in that company, that's how we do it. So for example, going to use Canva again, wrote the first 250K check, but for us, the majority of upside really came in the next round. For us to keep building that ownership, we have to have certain terms that we can invest from not just the first fund, but different funds as well. And that's just how kind of, not many people know, but venture funds, the venture company have many different funds. We have our early stage fund, we've got a follow-on fund, we raise multiple early stage funds, we raise multiple follow-on funds, we have a New Zealand fund. Sometimes they all kind of invest, following each other and things like that. So it's kind of, we need to have terms around that.
Yeah, but we kind of try to do this movement.
Specifically on the common first preferred stock. So usually when you start a company, everyone has common stock, and as soon as you get your first institutional kind of professional investors in, they'll insist on the creation of preferred shares. What it means effectively is, in the event of your company being dissolved and there being some assets distributed to equity holders, preferred shareholders take first. They kind of depend on the terms, but standard would be 1 times whatever money they put in. And common shareholders, if there aren't enough assets to give anything to them, miss out after that. If that makes sense. And so it's better to be a preferred shareholder. The reason that that's kind of insisted upon by pretty much every professional investor is that if there are future funding rounds, those investors will definitely insist on it. And so it's kind of like a precedent thing. Like you sort of want to set the cap table up correctly so that the company can go on to raise successive rounds and it's fair, such that all kind of professional investors are alike. Doesn't sound that fair for the founders. It's kind of just the way things are done.
But the other element of it, though, I've heard is that by having the preferred and common stock side of things, you are de-risking an element of it for the investor, right? And by being able to get off the bus first, if, for example, there's an exit event where it's not as high as you wanted. So by de-risking elements of it that way, it helps with not being too diluted the other way. So it's a trade-off of relationship.
That's right. And I think it's the fact is that most investors will just insist on it. So it's kind of a case of like, well, do you want to raise money from institutional investors or not? The thing is that in cases where things do really go wrong, preferred shares or not don't really matter often. Like it all comes out in the wash anyway. So it's kind of an illusion that it's really going to protect your value, but it's just standard. And it used to be standard in a much worse way, where you get like a 2 times preference, or you get funky other things, and at least it's now kind of simplified.
You guys prefer just 1 extra on that space?
It's pretty standard.
So on the valuation dilution product market fit front, are there any questions anyone in the audience wants to bring up before we move on?
Everybody around me laughs at me.
So I've got a weird question. Imagine you had a company that could raise all the money it needed from its customer base. What would you say to them?
All of it's money all at once. Like, what do you mean?
First round, so.
First round.
Yeah.
Really?
Like an equity raise, but like you go out to your customer base and you say, buy shares.
I think it's a great sign that customers want to invest in the business. It means that they love something about it, love the product. But when you're really building something over the next 10 years and your ambition increases, your roadmap gets more complicated, it really helps to have an investor who can invest again and again and again, so that you're not going out building individual relationships, so that they can be cornerstone investors in next round. So there is a trade-off. And when I was working at Simply Wall Street, we raised from our customers, but when we had to go back to fundraising, it's like they're tapped out, or angels tend to just tap out at like the pre-series A rounds. So there's kind of that trade-off. It just depends on how much you need to raise the next 12 to 18 months. If your ambition is bigger than your bank account and your customer's bank account, you have to look at other ways to kind of find and build a relationship that will get you term sheet every single time.
Would you see that as a plus though, that if someone had done it in a
I think for consumer brands like Monzo is a good example of this, where they did successive crowdfundings. We can show amazing levels of customer advocacy that people want to put their money into a business. It's good while the going's good, and then it's quite tricky when if they have a down round or things start to go wrong. So it sort of depends, like if you're specifically thinking that needs a, like if it's kind of one and done in the sense that you hope to crowdfund or equitably raise for your customers and then never have to do that again because it's giving you this buffer or something, like, it's quite different than if you are going to need to, you're on this path where you need to successfully fundraise. So I think it could be an awesome idea for you, but not the many business models that want to go down the venture route.
Lane.
I think the way that you guys talk about the user journey is very interesting. Because when I think about the user journey, I think about like steps on kind of like a linear path that users take, where you get awareness and then kind of you download, or right, you hit onboarding, you convert to paid, and then there's referral, right? But you guys are thinking about it, it seems like a level deeper than I think about it, which is actually the insights, not the metrics, right? And then when you think about it as well, I have two more questions past that. Number one is my number one and my first is that I want you guys to explain it more, right? Please talk about more about like when you think about the user journey, how do you think about the user journey, right? Like what does that mean to you? Second is, as an early stage investor, you don't have a lot of renewal as a general rule to go from. Like if a company's coming to you and they've been in the market for a short amount of time, you don't have a lot of renewal. Right, so how do you think about that in terms of the user journey as well, right, for early stage startups? And then also, sorry, this is the final thing would be like, how does that the vision? Sorry, my question is more on the user journey past the unit economics, right? No,
It's mostly about unit economics.
so if it's mostly about unit economics don't usually include user insight. Right. So when you talk about the user journey, what we talk about is more related to user insight plus unit economics, isn't it?
It's more around, so for example, we have invested in a company that scans your vein to detect heart disease. They've built a product, and the user journey is for sonographers to streamline their workflow so that it can be more efficient and cost effective. And so that user journey compared to the journey without the product is so much better than existing home. So there's that type of user journey as well.
Okay.
Is that kind of
Is a user journey versus the current user journey that the person who's suffering from the problem is having, right? Yeah, so it's like a before and after comparison, but it also, you guys also talk about like insights in terms of like golden moments, for example, or like what type of users are the users that continue, don't you, right? And that's not unit economics.
Yeah, like power users. I guess this is a point around the metrics, where like you can have an average, like on average, people spend 2 hours a week in our software. But underneath that, do you see that like 10% of people spend 35 hours a week and the rest spend like 15 minutes? And if you had that insight and then you're like, well, we went and spoke to all the ones that do it 35 hours a week, and like we found out they're doing something completely different to the others, or there's something about that customers, like they're all the same demographic, or they all have the same like sub issue. That would be really powerful. And then I guess we'd be like, oh, awesome. So what have you done to change the product? We've changed your marketing, we've changed something as a result of that. And if you were talking about like your customer lifetime value compared to how much it cost you to find the customer, you might then be able to say like, well, those people have such a high renewal rate, or they pay us like, they come back and pay us month after month, and they're worth 10 times as much as these other customers, and now we know where to find them, and we're just going to go find those sort of customers. That would be amazing. So it's kind of like, it's like threading the needle from how, like what you measure, what you observe, how you change your product as a result, and what it actually means for the business model. That's like very powerful.
I also kind of look at it as like you can measure everything and find insights in everything, and it's also quite subjective to, like I talked to a founder the other day who had a lending platform for like kind of trading with lending, and then he had this insight that like actually like Fulton Hogan could use this to lend between its own other places. Like you're making such a leap, but it was an insight that could be a pivotal change. Or you could have an insight that's like as small as A/B testing something, whereas the wording or the way you put words around. I think it's just understanding the 80-20 rule always applies, and also thinking actually what do I realistically need to change? And you should always be trying to find insights to change your hypothesis. You should be as you're finding ways to unpack them, kind of assessing, is this realistic based on resources, time, and roadmap?
I'd also say that is your user's successful journey aligned with your own successful journey? So I met a company where they would bring brands to China to help launch in China, and once the brand becomes successful, then that's their purpose, is to get the brands to be successful in China. But once that brand becomes successful, user wins, they stop using the service, and therefore you lose that customer. And so you always have this cliff where no matter, like, you get your customers to be successful, but then you lose them, versus getting your customers to be successful so that they keep on using your product. So it's kind of aligning the user journey success with your own company's success as well.
That's interesting.
Right. Next one, a question about the portfolio. I'm wondering if you could tell me a little bit more about your portfolio and how that influences your future investment. So we're quite agnostic in terms of the types of companies and industries we explore. We've lots of different types of companies. So in our portfolio, you've got your hardware, deep tech, software companies, health tech companies. So we're quite broad in terms of what we look for. Not necessarily that we invest in kind of what we've invested in will continue to influence what we invest in, and you can kind of see how the Blackbird fund has evolved over time. Like the first one was 90% software, the second one was majority software and some deep tech frontier technology. Third fund is kind of 50-50. So it's kind of evolving over time in terms of the investment thesis to find interesting or kind of interesting opportunities that come up. So it's not so much past kind of influencing the present, but more what we see that influences the future of what we want to invest in.
If we have companies that are doing something similar to things that a company in our portfolio does or might do, we wouldn't invest in two businesses with one another. So that's can be relevant.
But question on that.
I guess I only go for there. Just in contrast, obviously, I work for Startmate, so we don't have there's competition, right? So it's much easier for us, but we might be earlier stage. Yeah, but it's just Startmate. Anyway, we operate way earlier in the chain, but obviously people, we see a lot of our companies, even if they're really closely aligned, find value from working with those kind of companies. We aren't tied, fortunately, by it. You don't want to invest in that company that's trying to ruin another company of yours. But there is, probably the best way to look at it is, portfolio, I guess across Startmate and Blackbird, there's some form of, there is an underlying value set, and there's stuff like, are we love the product roadmap? There's usually like a kind of almost SaaS theology in it all, but that does change, and it is contextual.
So you guys were talking about like working with the customer and proving that you spend the time with your customer and develop the right solution for them. When it comes to investing, what do you look for to kind of show proof of that? Is it just like pre-orders, or is it different things?
Do you have in mind a particular business model that we could grab to?
Not really.
This is like free product, you're saying?
Yeah, or like, free product.
I'm not entirely sure I got the question.
I guess like if you're going for investment and you're developing a product and you're working with your customer and you had that pivotal moment or whatever, like how, when you go to investors, how do you show them that you've been working with customers? Is it emails or testimonies or what?
I would say it's a great sign to show that you work deeply with a couple of customers beforehand to really truly understand the problem and the user journey. And so even just talking about the case study, hey, we partnered with this company, they had this problem, this is how they used to do it, this is how we have saved them time, whatever, and they love the product, and they'll be our first paying customer out of our beta trial, and really just showcasing kind of deeply like what that means for that particular customer. In early stages, it's not so much like, can you get 10,000 customers? It's more like, can you show me 3 customers that you've truly changed in tech some way, that they're really willing to pay for this product and they love it, and
share that story.
Getting them to make a video about you would be awesome. Or like, yeah, one company at me yesterday, they're saying they contacted one of their customers, and one of the like frontline engineers made a weird fan YouTube video about their product unprompted, and they were like, look at this, and then that sort of thing's amazing.
There's a good story I think with Polter, like their first customer, like this farmer, he set it all up and then he went over to France with his family and then operated an old farm. You know, that's an insane customer story. You know, like one of your first customers.
One would be Thank You with Daniel Flynn. Some really cool examples of how he got his customer base to rally behind him. I think he got his customer base to create like YouTube videos to submit to get it into 7-Eleven. They did all sorts of crazy stuff. So like got someone to fly that you wanted to get into Woolies. So they flew a banner around the HQ of the office building. So all sorts of great stuff like that, but really impressive to find it. I think we'll keep moving on because I'm conscious of time. Speaking of which, time frames. What is the fastest turnaround that you've seen from initial engagement with the founder of startup to Timesheet? Originally, I actually thought it was partly, which was about 3 weeks, which was pretty damn quick. But I understand it's actually faster than that.
Cycles 3 days,
3 days.
which wasn't any of our deals.
And then following question to that, what are the sort of things, I know we've already kind of touched on lots of this, but what are some of those indicators that allowed that to move so quickly? Was it that they had?
Oh, I see company needs a internship.
Yeah. So okay, so getting the market as well, like this kind of mentioned before.
I mean, what I see is just really good at finding founders, right? So they had all the answers, they had all the customer data.
Yeah.
They had traction, like coming out of the league, it's really compelling about the track record in cybersecurity, it's a cyber company. Relatively early stage, those sub 12 months, so it's not like that much data to look at. So, and we just spoke to one founder in our portfolio is a security cyber company, cybersecurity company, and he was like, yeah, this guy is something. This is a really good opportunity. It was pretty cool.
Okay, and on the other side of the coin, what's the slowest deal you've seen that's still actually gone ahead? Doesn't have to be from you guys, but what's the slowest?
I've got one of my portfolio companies right now. Term sheet was signed Christmas Day or signed around there, still not closed. And because they have strategics on the cap table, strategics do that. It'll close, but we're all getting great answers.
And then what I'd kind of like to build into here is how long should founders be budgeting to raise their money? We touched on before, like if you went to 24 months rather than having to raise consistently and having short runs. If we contextualize that, how much time should found a budget to raise?
In 6 months, so just 6 months from starting your outreach to money in the bank.
Cool.
And it's not that like you're fundraising, they're not fundraising, like you're kind of always fundraising in the sense of keeping people who didn't invest in you but were interested along for the journey with the right amount of information. So it is a big part of your job.
Can we build on that point towards, particularly for founders that have raised and are looking at doing follow-on rounds? What are some of the nuances of differences from that versus the first round?
I was just going to say, between those times, the founders that tend to kind of get the investors buy-in quite early are the ones that constantly update, like kind of send monthly kind of emails, like here's the good, bad, ugly, here's what we're going through, rather than kind of radio silence until you need the money. So it's kind of that's what I mean. You're constantly thinking about fundraising, constantly thinking of aligning everyone, from your employees to investors to stakeholders, kind of constantly moving the train slowly towards each stop. So you kind of never really stop. Otherwise, it's kind of hard to get back started again. Like, hey, remember me from 12 months ago? I need money again. And this time I need $10 million. And so it's kind of,
I think actually adding on that, like, keeping people up to date consistently and actually being quite descriptive on what you're doing. Someone was saying to me today that you know, if someone else is talking to him about something that aligns to that field, if he has enough context to make the mental match in his head, he could be making a connection for you that you don't even know. So it's like creating that surface area to succeed.
Yeah. The other thing is like ideally, if things are going well, you keep people updated, you should not even need to fundraise. Like someone might come and offer you a term sheet, and then you can kind of create that competitive momentum quite quickly without having to do 50 copies. Before Blackbird, I was working in a later stage fund, which was kind of doing like Series C, D, pre-IPO type of investing. And what I noticed is that the power balance changes completely. So at that point, you're trying to get CEOs to take your calls and trying to show them like, you know, why they should, particularly in the market at the moment. So it gets easier and the power balance does shift, but that's also, it's the first couple of raises that are the hardest.
Cool. Is it ever too early to be trying to aim for customers overseas?
I would say, so this is kind of the thing with building a New Zealand-centric product versus a global from day one product, where your product really is a output of the customer feedback that you get. And so the feedback really matters. If you're getting feedback that is very New Zealand-centric, New Zealand problems, even though it's technically a global applicable problem that you can be solving, you're going to be building a product where at the end of the day appeals majority to New Zealand customers. And when you try to take it overseas, it's very different. So always, if you have a product that can be scaled globally, always try to think about how you can incorporate diverse types of feedback so that you can kind of build a product that can scale easily. This is a kind of a good / bad example, but when with Zero, it's done really well, but it's a New Zealand, Australian centric product. And when it tries to go to the US, they found out that there's like so many different types of regulation and different tax treatments, all these things, that it's really difficult to redo that whole fundamental way of building Zero from ground up. And it was a lot easier for the competitor into it to just copy Zero's user experience rather than Zero rebuilding their whole platform. And that's why Zero never really took off in the US and smashed them. So it's kind of like think about how that product that you're building can day one have no technical debt when you're trying to scale.
Thanks, great presentation. I would like to know, Blackbird, in which markets are you actually having relationships where you can have partners to leapfrog and get into kind of investments or into customers that are really important?
Well, I guess we predominantly invest in Aussie and Kiwi founders, but they might be based in other markets. So, but I guess a real strength in the US, we've had a lot of companies gone to market day one almost in the US, particularly SaaS models.
All kind of industries or?
Yeah, predominantly because of the kind of like the ability to go to the US on day one, ones that are distributing via the cloud. So like CapacityHQ and Canva, these sort of companies that are SaaS products. I guess we're starting to build a strength in US healthcare, kind of exposure to the major healthcare buying markets, so Europe as well. We've got companies headquartered in London, or at least one.
When you say Europe, what are you talking about? UK or Switzerland in healthcare? Or?
Well, it actually depends. And what I would say for that is we believe community-led VC. So rather than the font of wisdom being just hubs for or even the other 40, our job is to connect you through to the relationships, network of relationships within your companies.
Yeah.
So say you're building a healthcare company and you want to get into Europe, my job is to connect you with Harrison AI founders who sell to Sonic Healthcare's customers in Europe and the NHS fund trust based in Europe. And that's actually a lot more useful than someone calling up someone they went to an like did MBA or something like that, and trying to actually go from the top down. Like quite often you really want to be connected to head of engineering, blah, or the head of procurement, blah, or whatever. I can't guarantee you're always going to have the relevant relationship, but it's a very leveraged model that way, right? Like each of us have probably hundreds of relevant contacts in our networks, and we can, you know, that multiplied like, I don't know, 70, 80 companies in the portfolio now, and hundreds of operators, starts to become a very meeting and Startmate and a couple of extra thousand, starts to become a very, very leveraged network. And so what we put a lot of energy and money into now is looking at our success programs to improve the connectivity between nodes, because it's a very, very powerful thing.
So US, Europe, Asia.
I think we're weaker in Asia just because the portfolio don't sell that much into Asia. That would be one thing. But again, I would actually slice it more like industry than geo.
Okay.
Because we're looking for companies that can sell globally. They're always going to Asia.
Yeah.
But let's say customers.
So what are your strong industries where you have really good network?
Lots of cool. Any like software for sure. Growing in healthcare. A lot of automotive and transport and stuff. We've done a lot into vehicles and sort of thing.
What are you doing?
Not me personally, but through our company that is working with OEMs and
That's interesting.
I feel like you have something to ask, like you're like, do you have a specific connection somewhere in Europe? Or
No, but I'm looking at a lot of startups. So I was just interested. Where is your strength actually in there? You know, as what you recommended as the investor. You need to also choose your investor. That's what I say to the startups. You know, who is the best one for the purpose, and everyone has different strength and different relationships. So
Wholeheartedly fine to get with the community, I think.
yeah.
I think
It's a really lovely approach, you know, kind of, I like how you present and all of that. So it's just like, also good to know where are your strengths and where are your weaknesses, and you seem to be quite, you know, aware and open about it, which is really lovely. Thank you for that.
Any other questions?
Wine glass. No.
You guys have a super awesome portfolio of time companies, one more being out. So how many did you co-invest on? This is big terms. And how do you guys think about board seats and other observer or actual? And how much is that like for you guys as individuals?
I did my notes aside.
Oh, of course not.
This is the news. I feel like you made that whole.
No, I'm just talking about the New Zealand portfolio.
go one by one?
Windows Sunset, Windows Portugal. Fastest. Then pathways and multitudes. Co-invest in the we led one and co-invest with one, which is next. Co-invest with me. How we led. Board seats. All board seats and one.
And how should founders do that? Depends if that co-invest next versus later.
We really some support. Like, I appreciate your voice. It's just
Yeah.
Or what kind of plans think about co-investing or?
Yeah, because in New Zealand you end up with a lot. I think most rounds of co-invested rounds. It's like that whole finding dynamic of the fact that when you do find a lead, suddenly everyone's your biggest fan because it's Blackbird, right? It's real easy to fill around if you guys are leading it. How should founders think about it?
Yeah. Well, it's really up to the founder to dictate kind of who they want on the cap table. And so, for example, with multitudes, they wanted to raise a certain amount. We need to have a certain amount in order to justify our percentage of ownership as well, and make sure that valuation is high enough so that we can fit more people that Lauren wanted on the board on the cap table as well. And so we actually put out in our network, hey, we're leading this round, anyone interested, we can help put the cards together. So founder driven, but we help make whatever the founder wants.
Yeah, and
So-
you set a cap on the initial term sheet about how large you're happy for the round to go. So you're controlling that establishment.
We let the founder, we talked about it. It's not like we want this next kind of, it's a conversation of this is the maximum round the founder wanted to raise, this is how much we want to invest in. That means that there's about this much left. goes in Timesheet and then kind of everything.
So we'll go one more question. I think Lane, you wanted to ask a
Oh,
question, and then after that, I think
Last minute for Lane.
we'll wrap things up.
I have a tough one for the last one.
Yeah,
We
Right,
have
guys, come on.
flight.
Yeah.
Oh,
Huge round of applause. Thank you so much. Really appreciate it.
No, it's too hard. It's too hard.
That's
to
all right.
Anyone needs to be in touch, if not already, then of course we're missing it.
Yeah, so Phoebe and I will still be around.
Oh,
I mean,
Go, go.
Oh, no, my own question, my last final question.